Let's take a minute to define net debt and understand what the various components of it are. So here's an example in millions of dollars of calculating a company's net debt. On the balance sheet, this company has short-term debt of $5 billion, long-term debt of $35 billion, and therefore it has gross debt of $40 billion. But netting against that, this company has cash and cash equivalents of $10 billion. Therefore, its net debt is $30. There are two important points to make here about cash in this equation. One is that it's assumed that cash can be netted against debt that needs to be repaid. So for that reason, you can think about the cash as offsetting the debt because in a situation where it's required, that cash could be used to pay off. That may not necessarily be a good assumption, but it is a general assumption that's made. The other thing to note is that cash is not an operating asset that generates cash flow for the business. So in that sense, it wouldn't be included in the asset value of the company or the firm value. So cash is netted out from the total debt to get the net debt. Let's look at another example of calculating net debt for a company that actually has a positive net cash position, as this can definitely happen. So imagine a company now that has short-term debt of $5 billion, zero long-term debt, and therefore gross debt of $5 billion. We then need to deduct from that the cash position, which is $20 billion, and therefore that results in a net debt position of negative $15 billion. We would rephrase that to say it has a net cash position of $15 billion. Going back to our enterprise value calculation or equity value calculation, we would add the $15 billion of cash to the asset value to get the equity value. Or we would deduct the $15 billion of cash from the equity value to arrive at the enterprise value.